Building wealth isn't some glamorous overnight jackpot. It's a long, winding path that only starts to bend in your favor after you cross one critical number. And no, it's not $1 million. It's not even $500,000. It's $100,000. Hit that number, and suddenly the rules of money start working for you instead of against you. Most people approach wealth building like climbing a mountain. You work hard, you save, you invest a little here and there, but the summit always seems too far away. The slope is steep, the air gets thin, and every small step feels like it barely makes a difference. But once you cross $100,000, everything changes. It's like reaching the top of the hill and realizing gravity is now on your side. Let's rewind to that first stage of compounding. It's the most brutal part of the journey where most people give up. You're disciplined, putting money away, yet progress feels like watching paint dry. You invest $10,000 and get $600 in returns. It's easy to look at the numbers and think, what's the point? Compounding can feel like a myth at this stage. After you hit $100,000, everything changes. Earning 6% on $100,000 means earning $6,000. It's not just growth. It's growth on top of growth. Your money works harder for you. This is where the magic of compounding stops being a math problem and starts being a force of nature. Suddenly, your money feels alive. It's multiplying on its own. You're no longer pushing a boulder uphill. You're standing on the slope, and the boulder is rolling forward with its own momentum. And that feeling? It changes everything. You become more patient, more disciplined. You stop touching your investments because now you see what they're doing. It's the difference between trying to push a car and sitting behind the wheel with the engine running. But if it's that powerful, why do so few people ever reach that point? The short answer, psychology. The long answer, everything in our world is designed to keep you from getting there. The first obstacle is lifestyle creep. You get a raise, and instead of increasing your savings, you increase your spending. Suddenly, basic needs now include $7 lattes, 3 streaming services, and Uber rides that cost more than the groceries you bought. It's sneaky. You don't notice it happening, but every dollar you could be investing is now funding a lifestyle that doesn't actually make you wealthier. Then there's distraction. One day, you're committed to index funds, and the next, some guy online is screaming about crypto. Then your coworker's cousin made $40,000 trading options. So you panic, pull out your money, chase the next shiny thing, lose money, and start over from scratch. Every reset pushes your timeline further back. It's like planting a seed, then digging it up every 3 weeks to check if it's growing. Add in the emotional roller coaster of the market. Red week panic selling, green week FOMO buying, and you've got a perfect recipe for quitting before the magic happens. Most people don't fail because they can't reach $100,000. They fail because they don't stay invested long enough to let compounding work its slow, boring magic. Here's the uncomfortable truth. Below $100,000, it will feel like nothing's happening. You'll wonder if it's worth it. You'll feel like the world is moving faster than your money. And that's exactly why most people quit. They stop digging just 10 feet away from gold. But the ones who make it, they keep digging. They endure the boredom. They plant the tree and wait for the forest. So how do you get there faster, especially if you're not pulling in a six-figure salary or sitting on an inheritance? The answer is surprisingly simple: offense and defense. Offense is about boosting income. You don't need to start the next tech startup or become a real estate mogul. You just need one skill people will pay for. Can you edit videos? Tutor kids? Write resumes? Bake cookies? Whatever it is, offer it to people outside your immediate circle. Do a few gigs, then raise your price. Suddenly, that extra $200 a month isn't just spending money. It's rocket fuel for your investments. Defense, on the other hand, is about plugging the holes in your financial bucket. Look at your last 30 days of spending. You'll probably find subscriptions you forgot about, bills you could negotiate, and purchases that didn't actually make you happier. Every dollar you stop wasting is a dollar that can start compounding for you. And the earlier it starts, the longer it works. There's also one weapon most people overlook: automation. The less you have to think about saving and investing, the more likely you are to stay consistent. Use Roundup apps that invest your spare change. Set up automatic transfers the day after payday, so the money's gone before you're tempted to spend it. And when you get a raise, increase your automatic contributions immediately. If you never see the extra money, you'll never miss it. Now, let's talk numbers for a second, because this is where things get real. If you invest $250 a month, you'll hit $100,000 in about 20 years. $500 a month gets you there in 12. Push it to $850, and you're crossing that line in just 8 years. It's not magic. It's math. And math doesn't care about your income, your background, or your past mistakes. It only cares about consistency. Now let's say you've mastered the basics. You're investing consistently, trimming the financial fat, and maybe even bringing in some extra income. You're on the path, but you're still wondering how to hit $100,000 faster. That's where the real game begins, because there are two powerful levers that can dramatically speed things up: higher returns and stacking windfalls. Let's start with returns. And no, I don't mean throwing your money at the latest meme coin or praying a penny stock will go to the moon. Chasing big wins is exactly how most people sabotage their compounding before it has a chance to work. Instead, your focus should be on proven, diversified investments that have consistently performed over decades. Things like low-cost index funds. The S&P 500, for example, has historically returned around 8 to 10% annually. That might not sound exciting compared to someone's 200% crypto screenshot, but that consistency is the secret weapon. And here's something most people completely overlook: Fees. A 1% management fee might sound tiny, but over 30 years, it can eat away tens of thousands of dollars in potential growth. Keeping your fees under 0.25% and reinvesting your dividends instead of cashing them out might not feel like a big deal now, but those two habits alone can shave literal years off your journey to six figures. The difference between good enough and optimized investing is often the difference between hitting $100,000 in 12 years or hitting it in 9. The second lever, and this is where most people miss out, is stacking windfalls. Most of us treat windfalls like free money. Tax refund? New phone. Work bonus? Weekend getaway. But every dollar you toss into your investments early gets an extra year of compounding that no future contribution can replicate. Think about it. A $1,000 bonus invested today has 30 years to grow. The same $1,000 invested next year only has 29. That's not just an extra deposit, that's an extra year of growth. And those small decisions pile up. I'll give you a real example. Lou is a graphic designer making about $45,000 a year. Nothing flashy. But he decided to approach wealth building differently. Instead of trying to get rich overnight, he focused on stacking small wins. He picked up a few freelance gigs that brought in an extra $400 a month. Then he canceled his cable subscription, negotiated a lower car insurance rate, and found another $200 he could redirect each month. That's $600 going into his investment account, automatically, every month, no questions asked. It didn't feel like much at first. But 10 years later, Lou had crossed the $100,000 mark. And here's the kicker. Without adding another dime, that money doubled to $240,000 in the next 10 years. The snowball had taken over. It wasn't Lou pushing his money anymore. His money was pushing itself. It's about hustling long enough to let your money take over the heavy lifting. Once you cross $100,000, your financial life fundamentally changes. But there's another side to this story. The psychological traps that keep people stuck below 100,000. Money, for better or worse, is deeply emotional. One of the biggest traps is lifestyle inflation. Your expenses rise to meet your income. Many fail to build wealth because they spend every raise. Another trap is shiny object syndrome. You doubt your plan when tempted by the latest trend. Every reset robs you of compounding time. Emotional investing leads to selling during dips, then buying back at higher prices. Stick to your plan. Ignore the noise. Compounding is slow until it's sudden. Wealthy people stay patient during the quiet parts. Keep watering your seed. Growth will come. Automate your savings and investments. Consistency beats intensity. Each dollar is a tiny employee working for decades. Stop viewing compounding as a strategy. See it as a timeline. Early on, discipline is more important than immediate results. Measure progress by your contributions instead of the size of your portfolio. The results will follow once the habit is built. Imagine compounding as a snowball rolling down a hill. It starts tiny and slow, but eventually it becomes unstoppable. The best time to start investing isn't when you're rich, it's when you're broke and the stakes are low. Even if all you can invest right now is $20 a month, do it. It's about momentum and growth. The real freedom comes when your money works for you, allowing you to make choices and live your life fully. The first $100,000 is proof that you can build something from nothing and master the process. Start now, even if it's $5. That tiny step is how every journey to $100,000 begins. Subscribe, like, and comment below to share your journey toward financial freedom. Let's build a community together. Imagine waking up on the first of the month, and before you finish brushing your teeth, $4,000 has landed in your account. Not from your job or side hustle, but from money you already invested quietly in the background. That's the dream people chase when they talk about passive income, and ETFs are one of the cleanest ways to get there. $4,000 a month is $48,000 a year. To pull in that much from investments, you need a solid pool of capital. If your ETFs yield 4%, you need about $1.2 million invested. At 6%, it drops to $800,000. Push for 7 or 8% and you're down to the $600,000 range. The higher you chase yield, the more shaky the ride gets. That 8% option might look amazing until you realize it's built on shaky foundations. Finding the balance between yield and stability is crucial for peace of mind at night. ETFs are just baskets of stuff, some filled with dependable companies that pay dividends every quarter. Others are filled with bonds that hand over interest regularly. Some even include real estate or option strategies. You buy the basket, and it does the heavy lifting. One dividend cut doesn't tank your whole plan. The basket softens the blow and keeps your income steady enough to avoid panic during market fluctuations. One route is dividend ETFs. These are filled with companies that pay out portions of their profits as cash to shareholders. Think of them like reliable tenants who pay rent on time, except instead of a single tenant, it's dozens or even hundreds of companies contributing to your mailbox. Each dividend might feel small, but together they create a steady stream of income. Many companies even increase their dividends over time. Another option is bond ETFs. Bonds are essentially IOUs from governments or corporations, paying out interest regularly. A bond ETF bundles hundreds of these IOUs, spreading the risk across many borrowers. This results in a steady trickle of interest checks landing in your account. Blending bonds with dividend-paying companies builds a machine that can replace your paycheck. To achieve smoother cash flow, mix ETFs that pay monthly to cover rent, groceries, and bills. This ensures distributions come in every month. Some ETFs target monthly payers, giving you cash flow that feels real-time. This design detail separates vague investors from those with a solid income plan. Investing isn't just about percentage yield. It's about structuring your cash flow for your life. The desired money won't appear just because you want it. Starting small takes time and discipline. $10,000 in a 5% ETF yields $500 a year, about $40 a month. It's the seed of your investment journey. Many quit after seeing small returns, but every oak tree starts as an acorn. Time and consistency can turn that small investment into something meaningful. Think of your portfolio like a wall you're building brick by brick. The first few bricks don't look like much, but with each deposit, you're stacking higher. One day, you look up and realize the wall is tall enough to protect you, to shield you from financial storms, to stand on its own. You don't need fireworks, you need persistence. Picture it like climbing a mountain. The summit is $4,000 a month, but you don't teleport there. First base camp, $500 a month. That already feels like a win, covering groceries or utilities. Second camp, $1,000 a month. That's rent in some places, a milestone that illustrates your progress. Third camp, $2,000. That's your mortgage, car, maybe even a vacation fund, lightening your burden. Markets wobble. Dividends get cut in recessions. Inflation silently eats away at your buying power. Inflation means that $48,000 today won't feel like that 10 years from now. You need to aim higher. Taxes also mean that what you see on your brokerage screen isn't what hits your checking account. That's why you aim for a cushion. Risk management is vital. Don't put all chips on one high-yield ETF. That's gambling, not investing. Diversification matters. Spread across dividend ETFs, bond ETFs, real estate, or international ETFs. Diversification keeps your portfolio functioning even when one piece falters. Imagine running a restaurant where half your waiters are out sick. You keep serving customers because the kitchen still runs. Don't forget about fees. A 1% fee sounds small until it's scaled. On $1 million portfolio, that's $10,000 a year. Over 20 years, you could lose hundreds of thousands due to fees. They're the quiet killers of returns. Consider low-fee ETFs. Many charge as little as 0.05% or 0.10%. This can save you thousands. With low fees on $1 million portfolio, you pay $500 to $1,000 instead of $10,000. Imagine you've built up to $400,000 invested. At a 5% yield, that's $20,000 a year, or about $1,600 a month. That could cover your groceries, car, and part of your rent, making your job feel less suffocating. Grow that investment to $800,000, and you're looking at $40,000 a year, over $3,000 a month. Financial independence isn't a distant dream. It's right there on your portfolio statement. For those adventurous, ETFs can juice their yields by writing covered calls and collecting premiums. These funds can pay 7 to 10% yields, offering dessert-level income, but with risks. If you're consistently investing $20,000 a year and reinvesting everything, you could get to $4,000 a month in 15 to 20 years. If you already have a big portfolio, you can hit the target almost overnight by shifting into income-focused ETFs. It's not about comparing yourself to others. It's about knowing your path and sticking to it. Consistency beats heroics. The winners are those who invest steadily, reinvest dividends, and let time do its work. In the early years, reinvestment is rocket fuel, but later, taking income is the payoff. A paycheck feels like obligation. A dividend feels like freedom. That's when you know the capital is working for you. Absolutely. Earning $4,000 a month is possible, but it's not overnight. It's about discipline and smart choices. The result is peace of mind, Knowing cash keeps flowing even if your job disappears or you try something new. We live in a world where most dollars come with strings attached. Your boss expects output. Your hours trade for money. The first time you see a dividend or ETF distribution, it hits different. Nobody expects work or deadlines. It feels unfair in a good way, like discovering a cheat code in a game. This realization drives commitment toward financial independence. Some people get impatient, thinking their small dividends will never grow. That's short-term thinking, and why most people never make it. Remember, portfolios don't grow in a straight line. They crawl for years, then suddenly leap. Don't quit before the leap, or you'll miss the magic. The grind years are what feed the explosion years. Imagine a snowball rolling down a hill. You push and sweat, then it gains momentum. The pain is up front, but the payoff is backloaded. Now let's get personal with numbers. Start with discipline, adding $1,000 a month into ETFs. At 5% yield, that's $60 a month in income right away. But keep stacking, reinvesting. In 5 years, you've built close to 75 grand. Producing about $300 to $400 a month, that's the magic of compounding. 15 years in, you're looking at 300 grand and around $1,500 a month. 20 years in, you're flirting with 600 grand, generating $3,000 a month. You didn't win the lottery. You just showed up every month and let time do the heavy lifting. The money feels slow at first, but then it snowballs. Of course, not everyone can put in $1,000 every month. Some can only spare a couple hundred. That's fine. Progress is progress. Every dollar you put aside is a vote for your future freedom instead of today's impulse. The discipline you learn from investing often bleeds into other parts of your life. You start saying no to dumb purchases and noticing how many people live paycheck to paycheck because they never set up a system like this. People think it's all or nothing. They think if they're not financially independent, nothing changes. Wrong. Your investments start covering even small bills. Your life feels lighter. Imagine your portfolio pays your grocery bill every month. That's one less burden on your paycheck. Piece by piece, your investments lighten your load. Financial independence isn't a single finish line. It's a series of small wins stacked together until you realize one day you're free. Let's talk about fear. It's the reason most people never build wealth. Fear of losing money, markets crashing, or wasting time. Yes, markets crash. Yes, dividends get cut. But those who keep showing up despite fear are the ones who make it. If you panic and sell during the drop, you lock in the loss. If you sit tight and keep buying, you not only recover, you thrive. People think it's all or nothing. Wrong. The moment your investments start covering even small bills, your life feels lighter. Imagine your portfolio pays your grocery bill every month. That's one less burden on your paycheck. You don't need to be done to feel the benefits. Financial independence isn't a single finish line. Now let's talk about the elephant in the room, fear. Fear is the reason most people never build wealth. If you panic and sell during the drop, you lock in the loss. If you sit tight and keep buying, you not only recover, you thrive. The investors who stayed invested through 2008 or 2020 aren't bitter. They're richer. Fear doesn't pay dividends. Discipline does. Greed is what makes people chase the highest yields without asking why they're so high. It can lead to poor investment decisions. The sweet spot is balance. Enough yield to make the math work. Enough safety to sleep at night. When you build an income machine, you don't just change your finances. You change your options. Passive income isn't only about retiring. It's about buying back choice. Every extra dollar your portfolio generates is another ounce of freedom. Imagine earning $4,000 a month, every month, covering all your expenses. Your job becomes optional. If you love your work, you can continue. If you don't, you can walk away without fear. This is the power of income investing. But let's talk about something practical. Taxes. Many overlook this crucial aspect of investing. Dividends and interest can be taxed heavily. Aim for around $55,000 to $60,000 a year. In retirement, your tax situation often improves. Some even relocate to lower tax areas. Inflation is the silent thief. $48,000 today might feel abundant, but in 20 years, it could feel like 30. You can't just park in high-yield ETFs forever. You need a blend that also grows. Dividend growers are key here. They don't just hand you cash. They hand you cash that grows with the cost of living. That's the difference between scraping by and thriving. At some point, you'll face the choice between reinvestment and harvest. Reinvestment accelerates compounding by buying more shares. Harvesting feels surreal. Your portfolio isn't just numbers on a screen anymore. It's groceries, rent, vacations, freedom. You don't need to be perfect to win. Compounding forgives errors as long as you stay in the game. Imagine the weight lifted off your shoulders. See the choices you'll finally have with that $4,000 a month. Visualize the trips you'll take, the time you'll spend, and the projects you'll start. Waking up with a smile because money arrived while you slept. It all begins with the first step. Looking at what you have, deciding what to add, and picking an ETF or two. Don't wait for the perfect time or obsess over tiny details. Just start. Every $100 added is progress. Investing is about slow, steady consistency. Boring turns exciting when $4,000 lands in your account every month. So if you've ever wondered whether this path is worth it, the answer is yes. It's not easy, it's not fast, but it's real. Treat every contribution like a brick in the wall of your financial fortress. One day, you'll stand at the top of the mountain, look down at the climb you made. You did it. You bought back your freedom, and no boss, no crisis, no market panic can take that away from you. If you found this breakdown helpful, hit that like button, subscribe for more deep dives into building real financial independence. Drop a comment below sharing your own passive income goals. I'd love to hear how you're planning your climb.
What if I told you that you could retire in your 30s or 40s instead of working until you're 65 without winning the lottery or inheriting a fortune? Sounds impossible, right? But thousands of people are doing exactly that right now, and they're using a simple investment strategy that anyone can follow. Welcome to the world of FIRE, Financial Independence, Retire Early, where ordinary people are building extraordinary futures using ETFs. By the end of this video, you'll know exactly how much you need to save, which ETFs to buy, and the exact timeline to escape the 9-to-5 grind forever. Let me start with a story that'll blow your mind. Raj was a 35-year-old lawyer pulling in a six-figure salary, but he was miserable. Long hours, endless stress, and a job that drained his soul. 5 years later, at 40, he walked away from it all. Not to live in poverty, but to pursue his passion for writing full-time. How? He built a portfolio worth $1.2 million using ETFs and the FIRE strategy. Today, his investments generate enough passive income to cover all his expenses while he does what he loves. And here's the kicker: you don't need to be a lawyer or earn six figures to do the same thing. The FIRE formula, your blueprint to freedom. The FIRE movement is built on one simple principle: save aggressively, invest wisely, and let compound growth do the heavy lifting. But here's what makes it different from traditional retirement planning. Instead of waiting until you're 65, you're targeting financial independence decades earlier. The magic happens when you combine high savings rates with the power of ETF investing. So what exactly do you need? Enter the FIRE number, the total amount of money you need invested to retire. The calculation is brutally simple. Multiply your annual expenses by 25. That's it. If you spend $40,000 per year, you need $1 million. If you spend $80,000 per year, you need $2 million. This formula is based on the famous 4% rule, which states that you can safely withdraw 4% of your portfolio each year without running out of money for at least 30 years. But here's where it gets interesting. Not all FIRE journeys look the same. You've got choices, and those choices dramatically impact how much you need and how fast you can get there. Lean FIRE versus fat FIRE. Choose your path. Think of FIRE as a spectrum. On one end, you have lean FIRE, the minimalist approach where you retire with $500,000 to $750,000 and live on $20,000 to $40,000 per year. It's frugal, yes, but for people who value simplicity and freedom over material excess, it's paradise. You're cutting unnecessary expenses, embracing minimalism, and potentially retiring in your early 30s. On the other end sits fat FIRE, retiring with $3 million to $5 million and maintaining a lifestyle with $100,000 to $200,000 in annual expenses. You're not giving up the nice car, the vacations, or the comfortable home. You're just working strategically to build a bigger nest egg that supports a more luxurious retirement. The trade-off? You might need to work until your mid-40s instead of your early 30s. Most people actually fall somewhere in the middle, regular FIRE, spending around $50,000 to $80,000 annually and needing roughly $1.25 million to $2 million saved. The key is being honest with yourself about what lifestyle will actually make you happy. There's no point retiring early if you're going to be miserable counting every penny, and there's no point working an extra decade if you don't actually need all that extra money. The savings rate secret, your timeline to freedom. Now let's talk about the single most powerful lever you control, your savings rate. This is where dreams either become reality or stay fantasies. If you save 10% of your income, you're looking at working for over 50 years before you can retire. But bump that up to 50%, and suddenly you're retiring in just 17 years. Save 60%, you're done in about 12 years. Save 70%, less than 9 years. Let's make this concrete with a real example. Meet Sarah. She's 28 years old, earns $80,000 after taxes, and spends $40,000 per year. That's a 50% savings rate. She's saving $40,000 annually and needs $1 million to retire based on the 4% rule, 25 times her $40,000 annual expenses. Assuming her ETF portfolio grows at 7% annually after inflation, she'll hit her FIRE number by age 45. That's just 17 years of work instead of 37. But here's where it gets exciting. If Sarah can push her savings rate to 60% by cutting her expenses to $32,000 and saving $48,000 annually, she shaves 3 years off her timeline. That's 3 extra years of freedom. This is why FIRE followers obsess over savings rates. Small increases create massive results. The brutal truth? Your income matters far less than your savings rate. Someone earning $60,000 and saving 60% will retire faster than someone earning $150,000 but only saving 20%. It's not about how much you make, it's about the gap between what you earn and what you spend. Building your FIRE portfolio with ETFs. Here's where the magic happens. ETFs, exchange-traded funds, are the perfect vehicle for FIRE because they're diversified, low-cost, and simple. You're not picking individual stocks or trying to time the market. You're buying entire markets with a single purchase and letting time and compound growth build your wealth. The classic FIRE portfolio is the 3-fund portfolio, and it's exactly what it sounds like. 3 ETFs that give you complete global diversification. Here's the breakdown. First, 40% in VTI, the Vanguard Total Stock Market ETF. This single ETF gives you ownership in over 3,500 U.S. companies. You're invested in everything from Apple to small startups, capturing the entire U.S. market's growth. The expense ratio? Just 0.03%, meaning you keep more of your returns. Second, 30% in VXUS, the Vanguard Total International Stock ETF. This covers over 7,000 companies outside the United States, from Europe to Asia to emerging markets. You're not betting on just one country's economy, you're capturing global growth. Third, 30% in BND, the Vanguard Total Bond Market ETF. Bonds provide stability and cushion against market crashes. When stocks tank, bonds tend to hold steady or even increase in value. This balance is crucial for the 4% rule to work over 30-plus years. That's it. 3 ETFs, complete diversification, total annual costs under 0.1%. You can set this up in under an hour and automate your contributions. No stock picking, no market timing, no complexity. But maybe you want even more simplicity. Enter VT, the Vanguard Total World Stock ETF. This single fund owns over 9,000 stocks across the entire planet. If you're young and aggressive, you could start with 100% VT and gradually add bonds as you approach your FIRE date. It's the ultimate set-it-and-forget-it approach. For those seeking higher income during retirement, there's the dividend-focused portfolio. 50% VYM, Vanguard High Dividend Yield ETF, 30% SCHD, Schwab US, Dividend Equity ETF, and 20% HDV, iShares Core High Dividend ETF. These funds focus on companies that pay substantial dividends, generating cash flow you can live on without selling shares. The yield on these portfolios often exceeds 3 to 4% annually, providing passive income that grows over time. The research on portfolio allocation is clear. For the 4% rule to work, you need 50 to 75% in stocks and the rest in bonds or other stable assets. Bill Bengen, who created the 4% rule, found that portfolios in this range weathered every market condition over the past century, including the Great Depression and the 2008 financial crisis. Going 100% stocks increases your risk of running out of money during a market crash early in retirement. Going too heavy in bonds means your portfolio won't grow enough to sustain withdrawals for 30-plus years. Milestone tracking. Celebrating your journey. The path to FIRE takes years, and without milestones, it's easy to lose motivation. Let me give you a roadmap with specific checkpoints to celebrate. Milestone 1. Positive net worth. This is day 1, when your assets exceed your debts. For many people crushed by student loans or credit card debt, reaching zero is a massive psychological win. Milestone 2. $10,000 saved. Your first 5-figure milestone proves you can do this. At a 50% savings rate on a $50,000 income, this takes less than a year. You're building the foundation. Milestone 3. 1 year of expenses covered. This is your freedom fund. If you lost your job tomorrow, you could survive for 12 months without panic. The stress relief is immeasurable. Milestone 4. $100,000 invested. Charlie Munger called this, the first $100,000 is the hardest. Why? Because compound growth hasn't kicked in yet. At 7% annual returns, your first $100,000 will generate $7,000 per year without you lifting a finger. Every dollar you add from here grows faster. Milestone 5, Coast Fire. This is when your current investments will grow to your FIRE number by traditional retirement age without adding another dollar. If you're 30 with $250,000 invested and need $1.5 million by 60, you've hit Coast Fire. You can stop saving for retirement and just cover your living expenses. The psychological freedom is incredible. Milestone 6, Half FI. You're halfway to your FIRE number. The finish line is visible. If you need $1 million, you've hit $500,000. Momentum is building. Milestone 7, Lean FIRE. You have enough to cover basic expenses. It might not be luxurious, but you could survive indefinitely if you had to. This is your safety net. Milestone 8, Full FIRE. You did it. Your portfolio generates enough income to cover your desired lifestyle indefinitely. You're financially independent. Real-world case study, from broke to free. Let's talk about Martha, a 32-year-old teacher earning $55,000 per year. She was introduced to FIRE by a colleague and decided to go all in. She cut her expenses ruthlessly, sold her car and used public transport, cooked at home instead of eating out, and started a side hustle tutoring students. Her expenses dropped to $25,000 per year, giving her a 55% savings rate after taxes. Martha invested her $30,000 in annual savings into a simple three-fund portfolio: 50% VTI, 30% VXUS, and 20% BND. Over 13 years, her investments grew to $650,000. At age 45, she reached her FIRE number of $625,000, 25 times her $25,000 annual expenses. She didn't quit teaching entirely. She loved her work, but she went part-time, enjoying flexibility and freedom that most people never experience. Or consider Tom and Anna, a married couple with 2 kids. Tom was a software engineer earning $120,000. Anna worked in marketing making $70,000. They kept their combined expenses at $75,000 per year despite their $190,000 household income, achieving a 60% savings rate. They invested $115,000 annually into VTI and BND, building a portfolio worth $2.2 million in just 15 years. At ages 42 and 40, they reached Fat FIRE, maintaining their comfortable lifestyle while both transitioning to passion projects and spending more time with their children. These aren't lottery winners or trust fund kids. They're ordinary people who made intentional choices about spending and investing. Tax-efficient withdrawal strategy. Here's what nobody tells you about retirement. How you withdraw money is just as important as how you save it. The conventional strategy is simple. Withdraw from taxable accounts first, then tax-deferred accounts like traditional IRAs and 401s, Ks, and finally tax-free Roth accounts last. Why this order? Taxable accounts have already been taxed, and withdrawals typically trigger lower capital gains tax rates. By emptying these first, you keep your taxable income lower. Your tax-deferred and Roth accounts continue growing tax-free for longer. When you do tap into tax-deferred accounts, you'll likely be in a lower tax bracket than during your working years, paying less tax overall. And your Roth accounts, those grow and withdraw completely tax-free, giving you maximum flexibility in your later retirement years. A more advanced strategy is bracket topping, taking tax advantage withdrawals up to the top of your current tax bracket without exceeding it. If you're in the 12% federal tax bracket, you withdraw enough from your traditional IRA to fill that bracket completely, then supplement with Roth withdrawals if needed. This maximizes tax efficiency year after year. Common mistakes that destroy FIRE dreams. Let's talk about the landmines that blow up FIRE plans. Mistake number 1, underestimating future expenses. Life changes. You get married, have kids, develop health issues, or your interests evolve. The $30,000 per year that feels sufficient at 28 might feel restrictive at 45. Build in a 20 to 30% buffer. Mistake number 2, ignoring healthcare costs. If you're retiring before 65, you're not eligible for Medicare. Private insurance can cost $500 to $1,500 per month per person. That's $6,000 to $18,000 annually you must account for. Many FIRE plans fail because they forget this massive expense. Mistake number 3, Overestimating investment returns, using 10% annual returns in your calculations instead of the more realistic 7% after inflation, can add years to your FIRE timeline or leave you short. Be conservative. Mistake number 4, not planning for purpose. Retiring early sounds amazing until you realize you're bored, lonely, and aimless. Work provides structure, social connection, and identity. Before you retire, have a clear vision of what you're retiring to, not just what you're retiring from. Hobbies, volunteering, part-time passion work, figure this out before you quit. Mistake number 5, failing to communicate with your partner. If you're married, both people must be completely on board. One person grinding toward FIRE while the other resents the frugality is a recipe for divorce, not early retirement. Your action plan, the next 30 days. All right, we've covered the theory. Now let's make this real. Here's exactly what to do in the next month. Week 1. Calculate your FIRE number. Track every expense for the next 30 days. Every coffee, every subscription, every purchase. Be brutally honest. Multiply your annual expenses by 25. That's your target. Week 2. Calculate your current savings rate. Take your after-tax income, subtract your expenses, divide by your income. If you're below 30%, identify 3 expenses you can cut immediately. Week 3. Open a brokerage account if you don't have one already. Vanguard, Fidelity, and Schwab all offer excellent low-cost options. Set up automatic monthly investments into your chosen ETFs. Start with the 3-fund portfolio if you're unsure. Week 4. Create your milestone roadmap. Write down your specific checkpoints from positive net worth to full FIRE. Put dates next to each one based on your savings rate and timeline. Make it visual. Print it out, put it on your wall, and update it quarterly. The freedom waiting for you. Here's what this all comes down to. Every dollar you don't spend today is a soldier fighting for your future freedom. Every automated investment is a brick in the foundation of the life you actually want to live. The FIRE strategy using ETFs isn't complicated. Save aggressively, invest in diversified low-cost index funds, let compound growth work its magic, and give yourself the gift of time. Whether you're aiming for lean FIRE and escaping in your early 30s or targeting fat FIRE with a more comfortable 40s retirement, the principles remain the same. High savings rates, smart ETF investing, and unwavering discipline over years, not decades, of focused effort. Think about where you'll be in 15 years if you start today. While your friends are still trapped in cubicles counting down to a retirement at 65, you could be sipping coffee on a Tuesday morning, working on passion projects, traveling, or simply enjoying the profound luxury of owning your time. That's not a fantasy. That's the reality thousands of people have created using the exact strategies we covered today. The question isn't whether FIRE works, it does. The question is, are you willing to make different choices than everyone around you to create a different result? Are you ready to trade a few years of aggressive saving for decades of freedom? The math works. The strategy works. The only variable is you. Start today, calculate your number, open that brokerage account, buy your first ETF. Your future self will thank you.
Imagine someone who's worked their whole life and finally hits that magic number, $1 million. There's a sense of pride and relief. But right behind that relief, a familiar worry creeps in. The fear that this money will start shrinking the moment it's used. For many, that $1 million doesn't shrink at all. It grows, sometimes into 2, 3, or 5 million. The reason isn't luck, but hidden math, working in the background of nearly every retirement story. This hidden math runs on 3 powerful engines: how retirees actually spend money, market behavior over time, and the psychology behind financial decisions. These forces reshape the financial landscape of retirement, turning perceived decline into steady growth. The little decisions people make daily become powerful drivers of growth. Choices like waiting to sell an investment or spending less during uncertain times shape our financial future. Spending, though simple, is misunderstood. Most think expenses rise endlessly, but they actually settle into a natural rhythm that fits life's pace. Market behavior rewards those who are patient. While markets wobble and even crash, they also recover and grow, benefiting long-term investors. Human behavior plays a crucial role in finance. The emotions behind numbers, like confidence and fear, are significant in determining outcomes. This emotional side of money transforms plans into real-world results. Together, these three elements form a triangle of stability, supporting wealth expansion. It's not a fixed formula. There is no single equation predicting every retiree's balance. Instead, it's a living process evolving with life phases. Each force builds on the others, creating a cycle where thoughtful spending habits, consistent investing, and steady emotions reinforce one another. Imagine it like a well-balanced ecosystem. Remove one part and the others struggle. Keep all three in harmony and growth becomes not just possible, but likely. The secret is that retirement doesn't operate like a clock winding down. It works more like a flywheel. Hard to get moving at first, but unstoppable once momentum builds. Stories of retirees who watch their balances rise instead of fall aren't rare miracles. They're natural outcomes of this underlying system. The hidden math rewards steadiness, patience, and perspective far more than complexity or perfect timing. Lower spending gives markets room to grow. Strong market performance builds confidence. Confidence reduces emotional mistakes, which protects wealth and compounds peace of mind. The system isn't built on luck, but on patterns that favor patience, restraint, and long-term thinking. Once recognized, our perception of retirement changes from decline to potential, a time for growth. The fear of running out of money in retirement is common, fueled by grim projections and ads. Retirees often experience increased spending in the early years, enjoying hobbies and traveling. Many find themselves content with simpler routines. Local trips instead of global tours. Home projects instead of big purchases. Those early years often feel like a victory lap. There's freedom in waking up without an alarm and saying yes to spontaneous plans. Travel becomes meaningful. It's about visiting places that hold memories rather than chasing new passport stamps. The urge to upgrade fades, replaced by an appreciation for what's already there. Hobbies evolve, and time is cherished. Life feels full, but doesn't cost as much to sustain that fullness. Social patterns shift to more intimate gatherings. This slower rhythm doesn't feel like restriction. It feels like clarity. Retirees often describe it as finally realizing that happiness isn't attached to the price tag of an experience. The rhythm of life adjusts itself, and so does the rhythm of spending. Without even trying, expenses begin to stabilize, sometimes even decline. It's a quiet evolution that gives retirement its shape. Energetic at first, steady and content later on. Over time, many start valuing time itself more than anything money can buy. The days aren't about how much is left in the account, but about how those hours are spent. That change is subtle but powerful, and it's one of the main reasons why spending naturally tapers without feeling forced. Even the things that once felt essential begin to lose their grip. The need for constant upgrades fades when satisfaction replaces excitement. What once seemed like small luxuries start to feel unnecessary, replaced by the quiet joy of contentment. The more life simplifies, the less it costs to feel fulfilled. Instead of constantly worrying about whether the money will last, many realize it already is lasting. The fear that once hovered over every purchase starts to dissolve. Retirement becomes less about spending and more about savoring moments, memories, and peace that comes from knowing enough is enough. Research shows that discretionary spending declines with age, and healthcare costs do rise, but they rarely erase the savings from lower discretionary spending. The average retired household spends around the mid-$50,000 range per year. Spending rhythm shows a tapering off rather than a steep decline. Picture a couple who retires excited to see the world. In the first 5 years, they travel everywhere: Europe, Asia, family visits. But over time, the thrill of constant travel fades. They start spending more time at home and exploring local hobbies. Their lives are still full, but their spending naturally drops. Many retirees withdraw less than planned, not out of necessity, but comfort. The second force is the quiet, relentless power of market growth. Retiring with $1 million, withdrawing annually, logic says the balance shrinks. But over 20 years, that same portfolio could actually be larger than when it started, thanks to stable average long-term returns. That consistency acts like an engine humming quietly in the background. Each year, the portfolio might take a small withdrawal, but the remaining balance keeps compounding. The common rule of thumb for sustainable withdrawals is 4% per year. On a $1 million portfolio, that's about $40,000 annually. Meanwhile, the same investments might average around 7% growth over the long term, creating a simple but powerful gap, a 3-point spread in your favor. Think of it as a gentle current pushing wealth forward, even as small amounts are drawn out. Each year, the portfolio supports lifestyle needs and earns returns in the background. Pulling out 4% while earning 7% doesn't sound impressive in any single year. But stretched across 20 or 30 years, that small positive margin compounds into enormous results. Even accounting for market fluctuations, after 20 years withdrawing $40,000 per year from a $1 million portfolio, you could still have $2 or $3 million left. The reason isn't magic. It's that compounding continues working as long as the money stays invested. Research by financial planners shows that retirees following the 4% rule often end up with larger balances than at the start, even growing to multiple times their original size. This is the quiet math at work. Compounding transforms financial outcomes without dramatic headlines. There's always concern about market downturns, especially early in retirement, known as sequence of returns risk. History shows most diversified investors recover over time, as the long-term trend still bends upward. For those who stay invested and avoid panic selling, the math overwhelmingly works in their favor. Human behavior plays a crucial role in retirement finance. Numbers alone don't explain why many retirees end up wealthier than they began. The most powerful behavioral force in retirement is loss aversion, feeling the pain of losing money more than the joy of gaining it. Decades of research show losses hurt twice as much as gains feel good, shaping how retirees spend and invest their savings. For retirees, their portfolio represents a lifetime of work and security. Small dips in balance feel personal, impacting withdrawal decisions. Many retirees withdraw less than they could, averaging about 2% instead of the theoretical 4%, due to caution and fear of loss. A couple may think they can spend more after their investments grow, but that extra cushion often feels like safety instead of spent money. Because they're withdrawing less, more of the portfolio stays invested. That untouched balance continues to grow, and the compounding snowball gets larger every year. In most cases, they simply felt more comfortable spending less. The instinct to protect what they've built ends up being one of the strongest financial strategies possible. This cautious behavior also shines during downturns. Retirees reduce withdrawals slightly, delay big purchases, and give their investments room to recover. By keeping withdrawals modest when prices are down, they avoid selling assets at the worst possible time. That combination, restrained spending, steady investing, and patient behavior, keeps portfolios not just alive, but thriving. Now let's tie all three forces together and look at how $1 million can realistically turn into several million. Imagine a couple entering retirement with $1 million in investments and $48,000 per year from Social Security. This covers most of their yearly expenses. With an additional $40,000 withdrawal from their portfolio following the classic 4% rule, their total household income approaches $90,000. At first glance, withdrawing $40,000 a year from $1 million portfolio seems to lead to depletion over 25 years. But this overlooks compounding. If the portfolio grows around 7% per year while withdrawals remain at 4%, that 3% growth margin keeps building year after year. Over time, those withdrawals, combined with continued compounding, can exponentially increase the original million to several $million. Moreover, most retirees own their homes outright, adding significant home equity to their financial resources. This home equity provides flexibility and resilience in retirement plans, whether through downsizing or reverse mortgages. When people understand how spending rhythms, compounding, and psychology interact, fear turns into confidence. The idea of running out of money fades, replaced by a clearer question: what should be done with the abundance that grows? Retirement isn't about the countdown clock anymore. It's about the quiet, ongoing math that keeps working long after the work stops. So, before ending, take a moment to reflect. Maybe the question isn't whether $1 million is enough to last. Because the real secret is this: when handled with patience and perspective, retirement wealth doesn't just survive, it thrives. If this breakdown reshaped how retirement is viewed, consider giving this video a like and subscribing for more insights.